Let me start with a simple question. If oil prices go up, why does your life get worse? But someone else's life gets unbelievably better. Gas is more expensive. Flights cost more. Food prices rise. Inflation quietly eats your savings. And yet, somewhere in the world, someone is making millions. Per HR, that's not a metaphor. That's literally happening. Because right now, oil isn't just a commodity, it's a global wealth transfer machine. And in 2026, that machine is running at full speed. Oil just surged past $100 a barrel again, driven by geopolitical tension and supply disruptions. And this isn't just another price spike. It's a redistribution event. A shift of wealth from ordinary people to a very small group of players who understand how this game works. So today, I'm going to show you why oil prices are really rising, who actually profits hint. It's not just oil companies and how this entire system quietly moves money out of your pocket. Because once you see it, you can't unsee it. Let's begin with what you learned in school. Supply goes down, FE prices go up, demand goes up, FE prices go up. Simple, right? Except reality doesn't work that cleanly, because if oil prices were purely about supply and demand, they wouldn't move this violently. They wouldn't spike 10%, 20%, even 50% in a matter of weeks. So what's really going on? Let me introduce you to something economists love to pretend is simple: geopolitical risk. That's just a polite way of saying the world is unstable and markets panic. Right now, the biggest driver of oil prices isn't demand, it's fear. There's one tiny location on the map that controls almost everything. The Strait of Hormuz. About 20% of the world's oil flows through it. Now imagine what happens when that choke point gets disrupted. That's exactly what we're seeing in 2026. Conflict in the Middle East has restricted supply, creating what experts call one of the largest energy shocks in history. And when that happens, prices don't just rise, they explode. Oil prices are not set by how much oil exists. They are set by FE, how much oil the market thinks might disappear. That's a huge difference. Markets price expectations, not reality, and expectations can be manipulated. Let's talk about the first group everyone already suspects. Oil companies. Yes, they're making money. A lot of money. Some estimates suggest that major oil producers could generate over $200 billion in extra profits during this price surge. That's not normal profit. That's what economists call FE windfall profits. Basically, they didn't work harder, they didn't innovate. The world just got more chaotic. And they got richer. One major energy company just reported a 41% profit increase, driven almost entirely by higher oil prices. Another is expected to double profits because of market volatility. And here's the part most people miss. FE. It's not just the oil they sell. It's how they trade oil companies. Today are not just producers. They're traders. They hedge prices, use futures contracts, arbitrage global markets. In fact, some of their biggest profits come from volatility itself, not stability. So when the world becomes uncertain, they don't panic, they profit. Now, let's move to the group that almost nobody talks about, but arguably profits the most. Financial institutions, hedge funds, banks, commodity traders. Oil is not just a physical product, it's a financial asset. And like all financial assets, it can be traded. Every day, billions of dollars flow through oil markets, but most of those barrels don't actually exist. They're contracts, bets, speculation. And here's what happens when volatility spikes. Traders make money from price swings, hedge funds, exploit arbitrage. Banks collect fees from hedging activity. It's like a casino, except the casino is global, and the stakes are your cost of living. Over the past 20 years, oil has become heavily financialized. That means FE prices are influenced as much by investors as by real-world supply. So when oil spikes, it's not just because of a shortage, it's because capital is rushing in. Now, this is where things get interesting, because the biggest winners are not always who you think. When prices rise, us producers ramp up output. Fast, unlike traditional oil producers, shale companies can respond quickly. And right now, they're expanding production to capitalize on high prices translation. FE higher prices equals more drilling equals more profit. Countries like Brazil, Guyana, Venezuela are suddenly becoming major players. Why? Because high prices make previously unprofitable oil viable. And global buyers are desperate. Here's the irony. When oil gets expensive, renewables become more attractive. That means solar companies grow, EV adoption increases, governments accelerate energy transition. China, for example, is rapidly expanding its dominance in clean energy markets. So in a strange way, oil spikes are actually funding the future beyond oil. Now, let's talk about the part nobody wants to hear. Who pays for all this? You do. Oil price increases act like a global tax. But unlike taxes, you don't vote for it, you can't avoid it, and it hits everything. Transportation, food manufacturing, electricity. Even companies like Procter & Gamble are warning of massive profit losses because of rising oil costs. Which means, what? They raise prices and pass the cost to you. And just like that, wealth moves. Let's zoom out. Because this isn't just about oil, it's about power. Every oil shock in history has done one thing. Transfer wealth from consumers, producers, poor countries, resource, rich countries, households, corporations. And 2026 is no different. In fact, some economists argue that oil shocks are one of the fastest ways wealth gets redistributed globally, so next time you see gas prices rise, don't just think, oil is expensive. Think Simone is getting rich. Because they are, and the real question isn't, why are prices going up? It's Faye. Why am I on the wrong side of this trade? The story doesn't end with oil companies. In fact, that's just the surface. Because if someone zooms out far enough, they begin to see something much bigger. A system, not a conspiracy, not a coincidence. A system, he explains it like this. Oil prices are not just prices. They are signals. Signals about risk, fear, power, control, and in 2026, those signals have been completely distorted because what the market is reacting to is not just physical supply, it's perceived instability. When tensions rise in the Middle East, prices jump instantly, even before a single barrel disappears. That's because markets price what might happen, not what is happening. And in today's world, that difference is everything. In fact, during recent tensions, oil prices jumped sharply, simply because of the risk of disruption, not actual shortages that mean something important. The most powerful force in oil markets is not oil. It's expectation. He pauses here, because this is where things get uncomfortable. There's a hidden layer in oil pricing most people never see. Economists call it, the risk premium. This is the extra price added, just because the world feels unstable. Let's break it down simply. If oil should cost $70, but there's a risk of war, the price might jump to $100. That extra $30, that's not for oil, that's for fear. And in 2026, that fear premium is massive, because nearly 20% of global oil supply flows through one fragile choke point. And disruptions there have already removed millions of barrels from the market. So even if nothing else changes, prices stay high. Because uncertainty itself has value. He then shifts the focus. Because something unusual happened this time. This isn't just a normal oil cycle, it's a structural shock. In early 2026, oil supply disruptions reached historic levels, millions of barrels per Dalton Y disappeared from circulation. Key shipping routes were restricted at one point. Disruptions exceeded 13 million barrels per Dalton Y globally. That's not a small imbalance. That's a systemic shock. And here's the paradox. Demand didn't collapse, it just adjusted. Which means prices had only one way to move, up. This is what economists call, a forced price adjustment mechanism. When supply disappears, prices rise until demand is destroyed, not reduced, destroyed. Which leads to a brutal conclusion. High oil prices are not a bug in the system, they are the system fixing itself. Now the story becomes even more interesting, because oil supply isn't just about geology, it's about politics. Countries don't just produce oil, they control it strategically. In 2026, several key producers either reduced output, lost output, or weaponized output. And suddenly, supply wasn't just limited, it was managed. Historically, organizations like OPEC have influenced supply. But today, the situation is more fragmented, more unpredictable. Instead of one coordinated force, there are multiple competing agendas, governments, private companies, sanctioned nations, emerging producers, which makes the market far more volatile. And volatility creates opportunity. He leans into this part. Because this is where the biggest money is made. Most people think high prices equals profit. But that's not entirely true. For the smartest players, volatility equals profit. When prices swing wildly, Traders exploit price differences. Hedge funds ride momentum, banks structure derivatives, and every swing is an opportunity. In fact, oil has become one of the most actively traded financial assets in the world, meaning more money is made trading oil than producing it. That's the part nobody tells you. Now he connects it back to everyday life. Because this is where it hits hardest. Oil is not just fuel, it's the foundation of the modern economy. When oil prices rise, everything reacts. Transportation costs increase, which raises food prices, product prices, shipping costs, manufacturing becomes more expensive, which raises consumer goods construction costs, electronics, even services become more expensive, because energy is embedded everywhere, and suddenly inflation spreads. That's exactly what's happening now, as oil surged past $100 per barrel amid geopolitical tensions. Inflation concerns immediately return to global markets, which leads to the next layer of the system. Central banks don't produce oil, but they react to it, and their reaction changes everything. When oil drives inflation higher, central banks face a dilemma. Raise rates, slow the economy. Lower rates, fuel inflation in 2026. Most are stuck, waiting, watching, because high oil prices reduce the likelihood of rate cuts, which affects stocks, real estate, employment. So indirectly, oil controls monetary policy, and monetary policy controls everything else. Now the story expands globally. Oil is priced in dollars. That's critical. So when oil prices rise, demand for dollars increases. And historically, the US dollar tends to strengthen during oil shocks. Why? Because investors seek safety, inflation expectations, rise, interest rate expectations increase, which creates another layer of wealth transfer. Countries that import oil pay more, weaken economically. Countries tied to the dollar gain relative strength. So oil doesn't just move money, it moves power. By now, the pattern becomes clear. Every major oil shock in history has reshaped the world, and 2026 is no different. With Middle East supply disrupted, new players are rising. The United States is increasing exports rapidly. Latin America is emerging as a major supplier. And China is dominating the alternative energy space. In fact, the current crisis is accelerating a massive shift in global energy power structures. Which means, oil shocks don't just— the higher oil prices go, the faster the world moves away from oil, because suddenly electric vehicles look cheaper, solar becomes more competitive, governments push energy independence. So the very thing that makes oil companies rich also accelerates their long-term decline. It's a paradox. Short-term profit, long-term disruption. At this point, everything connects. Oil prices rise, but not randomly. They rise because supply is fragile. Markets are emotional, systems are interconnected. And every spike follows a pattern. Fear, price, increase, profit concentration, inequality, repeat. He slows down here. Because this is the part that stays with people. The real question is not, why is oil expensive? It's why does the system work this way? Why does instability create profit? Why does crisis reward certain players? Why does the cost always fall on the majority? And once someone sees that, they realize something uncomfortable. There are only two positions in this system. You are either paying the oil tax or collecting it. There is no middle ground. Most people are paying every time. They fill their gas tank, buy groceries, pay for travel. They are participating in the system, but not benefiting from it. And that brings everything full circle. Oil prices rise. Headlines explain it with war, supply, demand, but underneath, something else is happening. Money is moving. Quietly, relentlessly. From consumers, workers, households to corporations, traders, energy producers, and the system doesn't need permission. It just needs volatility. Because in the end, oil is not just energy, it is leverage. And the people who understand that don't just survive oil shocks, they profit from them. And the next time oil prices surge, he doesn't just see a number on a screen, he sees a transfer of wealth, a transfer of power, a transfer of opportunity. And the only question left is, which side of that transfer is he on?